Building wealth is one of those things that everybody wants to know how to do, but we're never taught how to do it. I went through a lot of schooling. I was never taught how to build wealth, but there is a system. There's a plan that you can follow if you want to build wealth. This is something that I kind of worked on, try to come up with. I say that building wealth is kind of like climbing a mountain because you have these different peaks you have to hit. There are different things you have to do if you want to become wealthy. So in this video, I want to do something a little bit different. It's our first time doing a video like this, but I want to go over exactly what you need to do in order to become wealthy because we're never taught what to do. Where do you start? What do you start doing with your money? How do you grow your money? How do you earn more money? How do you protect your wealth? But we always have to start at the bottom of the mountain. So let's go into how do you actually become wealthy. If you want to become wealthy, you have to follow what I call this climb to wealth. So C-L-I-M-B, with B being the top of the mountain. So you got to climb this wealth mountain with C being create your financial base, L being you got to lead your money, I being you need to do this interest-free living, M being you got to multiply your income, and B means be great. You need to know how to be great for your family, and you need to know how to be great for your community. If you want to become wealthy, you need to know how to climb to wealth. So this is the path to wealth. This is what I'll be going over. But in order for any of this to work, you also have to have the right mindset. And so, we're called the minority mindset. One of the reasons why is because if you don't have the right mindset, it doesn't matter what you know. It doesn't matter if you have all the right financial education. It doesn't matter what books you read. It doesn't matter what courses you take. It doesn't matter who your mentors are. It doesn't matter who your parents are. You're going to be broke. You're never going to have the chance to become wealthy because your mindset is broke. So you have to start with the mindset. If you don't have the right mindset, it is going to be impossible for any of this to work. And the right mindset means understanding that it is possible, that you can achieve wealth, and that you can put in the action steps and you can do what it takes. Is it going to be easy? No. Is it hard? Yes. Is it impossible? No. That means it is possible if you're willing to put in the work. And some people are going to be starting here. Some people are going to be starting way down here. Some people are going to be starting here. And so what you have to understand is everyone starts at their own starting point. But you have to get started. You have to have the right mindset. And then you need to know the different steps that it takes in order to become wealthy. So let's start with number one. C, create your financial base. So what that means is think of it like building a home. When you build a home, the first thing you got to do is you got to lay the foundation, right? You got to dig the foundation on the bottom. But if you want to build a bigger home, you want to build a skyscraper, the bigger the home is, the bigger the building is, the deeper your foundation needs to be. And so you have to start by creating your financial base. Because if you don't have any sort of financial base and you start to just trying to build, well, now you're going to have a shaky foundation and now it's very easy for your building to topple over. So you got to start with the foundation. You have to start by digging that base. And what that means financially is the first thing you got to do, we'll put this over here, is on C, the very first thing you got to do is you need to start by saving up $2,000 as fast as humanly possible. If you do not have $2,000 saved up right now, you are in financial danger. You are in a financial red zone. You are in a danger zone where if anything goes wrong, your AC breaks, your car breaks, your kid's arm breaks, your wife is sick, your husband's sick. If anything goes wrong, well, you're going to be going into credit card debt. You're going to be getting high interest loans to cover these costs. And you're going to take 15 steps back if you do not have any sort of financial cushion. Now, you want to have a bigger financial cushion, but you got to start somewhere. You got to start with something that way you have some sort of protection. And I know people like Dave Ramsey say $1,000. You can just think of this more of like an inflation-adjusted starting point. You have to start with something.
1,000's not enough anymore.
It's really not. I mean, you can see what's going on with the economy and inflation where you need to have a little bit of cash right now saved up. So you need to save $2,000 as fast as humanly possible. And then you need to pay off your high interest debt. So HI, high interest debt. So these would be things like credit card debt, your hard money loans, anything that is your high interest debt. Now, I know nowadays in this economy, high interest is really anything over 5%, 6%. But if you have any sort of credit card debt, those hard money loans, any of those, the 0% APR things that you financed but have not paid it off yet, that's what you have to get rid of before you do anything else. You know, people ask, oh, should I start investing my money? Should I put my money in stocks or crypto or real estate? If you have credit card debt, you should not be worrying about any of that. What you need to do right now is you got to get rid of this credit card debt as fast as possible, because that credit card debt is literally skinning you alive financially. Your credit card company is getting rich off of your financial ignorance of not understanding that, hey, they're making 15, 16, 17, sometimes even 25% a year off of your credit card debt. When you put your money in the stock market, if you're an investor, you're trying to get 7, 8, maybe 10% a year on your money. If you get 10% a year on your money, that's great. But if you have to turn around and pay 15% or 20% to your credit card company, you're still losing. So you have to pay down this high interest debt as fast as possible. Now, the reason why I say you got to pay down you got to save this $2,000 first and then pay off this high interest debt is because, let's say you start paying off your credit card debt and you're paying it off, you're seeing some traction, you don't have any savings yet, but then your car breaks down. You take it into the dealership and they say that you need to fix something and it's going to cost you $800. You have no cash saved up. So what's going to happen? Well, you took 2 steps forward, now you just took 4 steps backwards.
Right back to the credit cards.
You got to put it on your credit card. So you have to save up some cash. While you're saving up this cash, keep making your payments. But as soon as you save up this $2,000, now the next thing you got to do is you got to attack this credit card debt as fast as possible. The way you can save this $2,000 as fast as possible is, one, you stop spending money on crap. Stop buying things that you don't need, and start accumulating this cash by now selling things as well. So everyone has crap in their house. Everyone has stuff that they're not using. Everyone has clothes that are old. Go take those clothes, sell them. Take some of the crap that's just sitting there collecting dust, sell it. And maybe downsize on your car, maybe downsize on your apartment, maybe downsize on your home, because right now, if you don't have $2,000 saved up, you are in financial danger. You got the $2,000. Now the way you pay down this credit card debt, I mean, you can follow the debt avalanche or the debt snowball method. It really does not matter. The debt snowball method means you're going to start by paying down the lowest balance debt first. And the debt avalanche method is you're going to pay down the highest interest debt first. So the whole idea with this is, if you pay down the highest interest debt first, then you're going to stop paying interest faster. You're going to pay it down faster, but it's going to take you a longer time to pay down some of your debt balances, because you might start with a debt balance that's a lot higher. So let's assume that you have a credit card debt that's $5,000 and you have another debt which is not as high interest, but that's only $2,000. Well, now you're going to start with the credit card debt, and it'll take you higher to pay off the $5,000 than the $2,000. So, you just have to understand the way it goes. And so the advantage of the debt snowball is you're going to start with the smallest balance first. You would start with the $2,000 balance first. That way you feel like you're getting those psychological wins. Hey, I paid something off. I'm winning. I'm doing something right. And then you go to the next one. So it really doesn't matter which one you do, as long as you start paying down your debt. So that's why you got to pay off your high interest debt. So you save $2,000, you pay off your high interest debt. Now you have established that little base. You have a little bit of cushion. You don't have the high interest debt that is burdening you. Now you can move on to L. Lead your money. So the way that money works for the majority of Americans is, people make money, they pay their taxes because it's automatically taken out of their paycheck. They spend their money, and then they wonder where all their money went. It's literally like, I mean, if I diagram it, it's money, tax, spent, and then it's, where did my money go? This is how money looks for the majority of people. That's why I think it's 78% of Americans are living paycheck to paycheck right now. That means for 8 out of 10 people living in the richest country in the world, you make money, you spend it, and then you have nothing left for yourself. So what you need to do is you need to flip that. Because what wealthy people do is they make money, they pay themselves, and then they spend whatever's left. Well, the majority of people are making money, they spend it, and then they try to save or invest whatever's left. So you got to flip this mindset. You got to change it so now you pay yourself, then you're going to spend whatever's left. The easiest way to do that is to follow something like our 75-15-10 plan. So I'm just going to flip this cool new whiteboard thing. It's got my
we got fancy for this one.
We got fancy for this. Drop something. But 75, 15, 10 says that now for every dollar that you earn, 75 cents is the maximum that you can spend. 15 cents is the minimum you should be investing. And 10 cents is the minimum you should be saving. Now, I'm going to put a little asterisk here because you have to understand how to save your money the right way. But now what you're doing is you created a system for your money. Now what you've done is anytime you get paid, you're always going to invest some money and you're always going to put some money aside for your savings. So you're paying yourself first and you're living off of 75% maximum of every dollar that you earn. Now the first thing that anyone's going to say when they hear this is, how in the world am I supposed to live off of just 75% of every dollar that I earn? Well, think of it this way. What if the government said, you know what, we're going to raise your taxes. We're going to raise your taxes by another quarter, and so you got to pay this extra tax. Well, now you can complain about it, you can throw a fit, you can get angry, you can make an angry post on Twitter and Facebook, but then you're going to have to pay your taxes. You're going to have to find a way, right? Same thing here. Just create a system where you just find a way. And that might mean that you create separate bank accounts. I recommend you have 3 different bank accounts where now you have one bank account for your spending, one bank account for your investing money, one bank account for your saving money. So now as soon as you get paid, you have automatic withdrawals that take some money out of your bank account from your checking account to move some money here and to move some money here. That way you can't see the money and you know that, hey, the money that's left here in this my checking account here, so this is my checking, this is the money that I can spend. Then you can open up another checking account for your investing cash. This is not an actual investment account. This is just the cash that you want to invest. Now there's a lot of different ways that you can invest your money. We'll talk about that in just a second. And then you can have a savings account here for your savings cash. So automatically have this money just go boom, boom, boom. That way now you got paid and money automatically leaves your account. Now you're paying yourself, and this is the money that you can go spend and buy whatever you want. You want to buy some Lululemon leggings? Spend it here. You want to buy some extra guac? Spend it out of here. You want to go buy something nice? Cool. As long as you can afford it out of here, that's what you need to know. So when we talk about leading your money, this is where now you have to start knowing how to invest your money. That's what I want to focus on here, because wealthy people don't get rich by saving their money. They don't get rich by spending the money. They get rich by investing their money. What the majority of people are trying to do is they say, hey, I want to have nice things. So what do? They go make money and then they go and finance a nice car. They go and buy these nice things that make them look rich. But the things that make you look rich, ironically, are the things that are keeping you broke. Mm-hmm. So what you need to do is you need to use your money to buy investments, assets. These are things that you're buying for the sole purpose of making money. Now, the first time I started learning about this, I was in college because I didn't grow up learning about any sort of financial education. This blew my mind because I didn't know that there was this thing called assets in the world. I didn't know that there was a such thing that could pay you with passive income. I didn't know that assets existed. I just assumed that you made money and you spend it. But what wealthy people are trying to do is they're trying to buy as many assets as possible. So assets are things that you buy for the sole purpose of making money. When you spend money, when you go and buy some nice shoes, you don't buy it for the sole purpose of making money. You're buying it so you have shoes on your feet. Assets are things you buy for the purpose of making money. So now instead of going out and buying shoes, and I guess shoes can be a difficult example because people buy shoes to flip them, assuming you're not flipping the shoes. What you're trying to do is you're trying to buy the shoe company. You're trying to buy the clothing company. Or you're trying to buy shares of the company that's selling you the products that you're buying, right? When you go out and you spend money at Starbucks, you go out and spend money on Amazon, you go and spend money at Lululemon, you're the consumer. That's the consumer mindset. The consumer mindset is, I want to consume, I want to buy, I want to have these nice things. But what you want to be is the producer mindset here. The producer mindset is, okay, instead of me buying these nice things for myself, how about I buy the thing that sells these things? So I want to buy shares of Amazon. I want to buy shares of Lululemon. I want to buy shares of Apple. I want to buy shares of the things that I buy. Now, I'm not telling you what to buy, just an example. Or this could be buying things like real estate. Real estate is what changed my life because I was, this was back after the 2008 crash. I was in college, I had some cash, and I went out and bought my first rental property. So I went out and bought a condo, not to live in myself, but I bought it for someone else to live there. I bought it so a tenant could come there and live in my condo. And now all of a sudden, I created a new income stream that was paying me a profit of $250 to $350 a month. The tenant was paying $600. You take away the expenses, and I was left with $250 to $350 a month in profit every single month. And this is money that I was earning without having to do anything. I wasn't going to work to earn this money. I wasn't having to physically do something to earn this money. I owned the asset, I owned the real estate, and every month it was paying me just because I owned the asset. And that was when the gears started turning in my mind. Mm-hmm. Holy moly, I wanted to buy a Beamer before, a BMW. But what if now I spend my money and my time trying to buy my real estate? And what if each unit that I buy makes me $300 a month? Well, if I can find a way to buy 10 units, that's $3,000 a month without me having to do anything. If I can find a way to buy 100 units, that's $30,000 a month without me having to do anything, right? And now it's like, holy cow, how do I do that? Because it sounds crazy. How are you going to buy 10 units? How are you going to buy 100 units? Well, you have to start with one. Mm-hmm. Then you do the second, and then the third, and then you realize how you can do bigger deals and more deals. But you have to start with one. But you have to start with actually the mindset. So you have the mindset, now you have this education, you start putting this money aside for your investments, but then you got to start doing. And there's a lot of different ways that you can invest your money, right? We talked about real estate. We talked about stocks. You can invest in cryptocurrency. That's been popular nowadays. Now, kind of a forewarning, cryptocurrency is very volatile. Mm-hmm. It's speculative. I own Bitcoin. I have some cryptocurrencies, but I also understand that it's very volatile. It has its own fair share of risks. So you have to understand that. This shouldn't be your entire investment portfolio. If you want a well-diversified portfolio, you just got to understand the risks. But you can also invest in things like businesses. Like Minority Mindset is a business that I own. I also invest in other companies. I'm an investor in a company called UpCounsel. So I'm an attorney. And I like the idea of revolutionizing the legal workspace. And UpCounsel is trying to do that. So if you are a business owner and you want to get legal work done for your business, you might call up a law firm and they're going to charge you a lot of money if you want to get legal work done. So not only is it bad for you, because now you're paying a ton of money to get legal work done and you have no way of knowing if this attorney is good or not, but then it's also bad for the attorney because the attorney that's working for the big firm isn't making the big bucks that you're paying them. They're getting little pennies out of that because the whole firm has to take like a huge chunk of their month or their hourly fees because you got to pay your equity partner, you got to pay your advisor, you got to pay all these other people. So it's a very inefficient model. So the company that I'm invested in now is we're trying to change that. Where now you can work directly with the attorney through a freelancing site. It's a site where you can go on to. You put in whatever job that you want to do, and attorneys will bid for your job. And now you can see the reviews of the attorneys, so you can see who's good and who's not good. And it's cheaper for you because now you don't have to pay the fees for the whole firm. And the attorney actually walks away with more money because they don't have to pay all the fees to the firm either. Wow. So it's a win-win. The only person that's losing is the big corporate legal firms, but that's what technology is. So you can invest in businesses. But if you are investing in businesses, you just want to make sure that you understand how much work is going to be involved on your end. Because if you really want to be hands-off and you want to invest in businesses, you don't want to be the person that's trying to grow the business. Now, Minority Mindset is a company that I own, but I'm working to grow it because that's my active investment. But I'm not actively working in UpCounsel and my other business investments. Those are things where I provide my capital and I might provide my advising, but that's what I'm trying to do to help grow them. You can invest in things like physical commodities, gold, silver. Now, those, you really don't see the same type of growth as you do in things like stocks, That's more of like a hedge, but those kind of go over the different ways that you can invest your money. When we talk about buying assets, the whole idea is you are trying to grow your money. You're trying to buy something that's going to make you money. You're trying to put your money in a place that's going to grow and appreciate and pay you. So that's the goal you have to go in with investing. There's so many different ways that you can invest your money. That's kind of like a brief little overview of what investing is and different ways that you can invest. And then you have to understand saving. So I'll put a little asterisk here. The thing that you have to understand about saving is you're never going to make wealth. You're never going to become rich by saving your money. This is your way of protecting yourself from a financial emergency. That's it. You are not going to get rich by saving your money. I don't know how many times I need to say that, but this is but the thing is, the reason why I say that so many times is because many of us, myself included, we're ingrained with the idea that saving is the path to wealth. I mean, my family is from India, a state in India called Punjab. And traditionally, Indian people are heavy savers. We're a save-heavy culture. Like I joke about this, but American people make $1 to spend $2 with credit cards. Indian people make $1 to spend 20 cents because they're so cheap. All they want to do is save all their money. And okay, it's good that you're not blowing all of your money, but you're never going to get rich by saving. And so, there's neither of those are the right way to do it. What you need to do is understand what is saving and how to save your money the right way. The reason why I say you're never going to get rich by saving your money is because think of it this way. In your grandparents' time, $50,000 was probably a lot of money. You could buy a very nice home for 50 grand a couple generations ago. Now, if you took that 50 grand worth of cash, you buried it in your backyard, and then it just stayed there, and then now you get to go and get this 50 grand, you're gonna say, hey, 50 grand, better than nothing. But that 50 grand a couple of generations ago had way more buying power. It could buy you way more things. It could buy you a much nicer home. It could buy you way more assets. It could buy you way more things. I mean, you were rich if you had 50 grand a couple of generations ago. Nowadays, 50 grand isn't that much. You can't retire off of 50 grand. And so you have to understand that your cash is going to lose value to inflation. Inflation is what's eating away our buying power, is eating away the value of your currency, and it's going to continue to happen. So if you're just saving all of your money, yeah, you have some cash in the bank, but the value of that cash, the buying power is going down every single day. So why do you save? You save for emergencies. Your kid breaks their arm, you break your arm, your spouse breaks their arm, something goes wrong. Well, you have this cash to fall back on that's easy to access.
And you talked about before $2,000 being kind of the baseline. Do you ever kind of increase that, or?
Yeah, so here now we're going to try to increase that. So the goal here is somewhere between 3 to 12 months worth of expenses. And this is going to depend on your risk tolerance. If you're okay taking on higher risks, you're younger, you don't really have that need for higher savings, then maybe you only save 3 months worth of expenses right now because you can take on higher risks. But if you have a family, or if you're not as risk prone and you want to be more cautionary, then maybe you save 12 months worth of expenses, but nothing more than that. After 12 months of expenses, you do not want to be saving more than that because now you're excessively saving. You don't want to be saving more than that. So you pick your savings target somewhere between 3 months and 12 months. And then after you hit your savings target, what you're going to do is you're going to take this 10% and you're going to put it right here into your investing money. So now it's going to be 75-25. Spend no more than 75, invest at least 25. So you want to invest as much as possible. If you can do more investments, it's even better. But that's what you have to understand about the saving is you don't want to be in that game of just saving forever, because that's not going to take you anywhere. So this goes over L, the lead your money, which brings us to I, interest-free living. So L was really just about investing your money. I, interest-free living, is about spending smartly. Because this is one of those things where, what do you mean spend your money smartly? Spending money is easy. I take my cash, I go to the mall, and I go buy something. What are you talking about, Jaspreet? No. That's the reason why so many people are broke, because they don't know how to spend their money the right way. There's a difference between being able to buy something and being able to afford something. If you have $50 in your pocket, you can go into the Apple store and walk out with an Apple iPhone. $50 a month, right? But just because you can you can buy it doesn't mean that you can afford it. Buying it means I can access it, meaning I can use a 0% APR, meaning I can use buy now, pay later to purchase this item. Afford it means I can buy it and I don't gotta worry about the price. If you wanna really become wealthy, you gotta stop financing the things that do not pay you. So your iPhone, your clothes, whatever it is, your vacations, you gotta stop financing these things. People are gonna say, wait, my iPhone, that's 0% APR. What you talking about, Jaspreet? Well, there's a reason why 0% APR is so profitable for banks and companies, because when you go and buy something with 0% APR, you don't feel the pain of buying it. So you can go out and buy more things that you can't afford because you can just do 0% APR for all of it. And what ends up happening is a lot of people end up overspending. They buy more than they would have if they didn't do 0% APR. And then that 0% APR period ends, they weren't able to pay it off, and now you get slapped with that 22% interest rate. Whew. So this is where you have to be smart. When you go out and you're spending money, you need to make sure you can afford it, not just buy it. So what does it mean to afford something? We're gonna jump back into the video in just a second, but before we do, if you are interested in learning more about how you can start generating passive income, our team put together an amazing guide that will walk you through how you can start generating passive income today. You don't need a ton of money to start generating passive income. What you need is the right financial education. I mean, there are some passive income strategies that don't cost you a lot, and there are other passive income strategies that are completely passive that will cost you more money, and this guide will walk you through the different passive income strategies. That way you can understand what are the best ways to start generating passive income and what's the best strategy for you. You can download our guide to start generating passive income for free when you sign up for our daily newsletter. So if you want to learn more and see how you can start generating passive income, I'll put the link to how you can download our free guide in the description below. Now let's jump back to the video. Well, the simplest thing that you can do is follow my rule of 5 when it comes to non-necessity liabilities, things that don't make you any money. There's nothing wrong with buying something that is a liability. I want you to buy all the nice things that you want. I want you to have all the nice things that you want. I just want you to be able to afford it first. So my rule of 5 says if you cannot buy 5 of them, you cannot afford 1 of them. Simple way to understand the difference between buy and afford. So now what you know is how do you afford versus buy. But the next thing you got to do here is, we talked about the high interest debts in C. But what about your low interest debts? You got your student loans, you got your car payment, you got your mortgage. All these things are, there's still payments you have to make. When do you pay those off? Well, this is where you have the opportunity to pay them off. What you have to understand is when you have a low interest debt, so you got your student loans, you got your mortgage, let's assume that your mortgage is 4%. If you have a 4% mortgage, you might be able to beat that in the market. You might be able to get just a 7% average return and beat your mortgage. But there's also a chance that you might not. So this is where, I can't tell you what's right for you, but you have to know the risks and see what the potential rewards are. If you are younger, you're willing to take on more risks, you have no need to kind of pay that down right now, then hey, by all means, go and invest it, but understand the risks. If you rather just be done with the payments, not have to stress about making the payments, you just want to own your assets free and clear and never have to worry about it again, then put more money towards paying it down because you're looking for that freedom. You're just looking for that stress-free life. But if you're looking to live bigger, you want to have more investments, you want to take more of the risks, then you have to do the opposite. So you got to know your goal here because your goal is going to determine what you do. This is one of the things that I don't like about some of the financial educations out there because they always say, this is what you need to do if you want to become successful. You have to go out and buy real estate. You have to go out and buy single family real estate. And someone else will say, no, you have to go out and buy multifamily real estate. And someone else is going to say, no, invest in stocks. It makes no sense. You have some people that became incredibly wealthy through the stock market. You have some people that became incredibly wealthy through multifamily real estate. You have some people that became incredibly wealthy through single family real estate. There's no one size fits all, especially when it comes to your money. So one of the things that I'm trying to do is really just talk about the different ways and the different things that you need to know, the financial education. That way you can make the right decision for yourself. What's right for me might not be right for you. What's right for you might not be right for me because my goals are different, my risk tolerance is different, and the amount of effort and work and my skill set is different. And so what I'm looking for is going to be different than you. So when it comes down to paying down this low interest rate debt, nothing wrong with paying it down. We just got to understand what that means. I mean, if you have a mortgage that's costing you 4% a year, you pay it down 2 years early, you got a guaranteed 4% return on your money those 2 years because you didn't have to pay interest on your mortgage for those 2 years. Versus if you put that money in the market, sure, maybe you could have gotten a 6% return or a 20% return, but you could have also potentially lost 2% or 5%. You never know. You have that risk in the market. Versus when you pay down the mortgage, it's a guaranteed return. And so you have to see where on the risk tolerance you are. The real key here going forward is what do you do that way you don't put yourself in the same financial mess that put you where you were before. So you want to know what it means to afford something versus buy something, which brings us to M, the next part of the climb to wealth, which is multiply your income.
Our favorite letter here.
This is where things get fun. Because now you understand how to use your money. Everybody, I mean, if you go out and you ask the 78% of Americans that are living paycheck to paycheck, what is the number one reason that you're not able to become wealthy? Or why are you not become wealthy? Or what is contributing to your financial stress? Everybody is going to say, I'm not making enough money. If I was making more money, all my problems would be solved. But the data does not agree with that. Because when people go out and they get a raise, they get a promotion, they get a bonus, what happens? Your income, boop, went up, and then suddenly your expenses, boop, go up with it too. Why? Because now you got a raise. You want to go and celebrate, get a nicer car. I got a raise, I make more money, I should have a nicer car. Or you got a bonus. Well, I worked hard to get my bonus. I should go to Cancun for a vacation, right? Take my family, go celebrate, or go to Disney World. This is what happens when people make more money. They go out and they spend more. It is a natural thing to do when you don't know what to do with your money. I showed that in the L part where you make money and you spend money and then you wonder where your money went. This is a common thing for so many people. Just look at lottery winners. Why is it so many lottery winners are broke after 5 years? Why is it that so many high income earners are broke? Athletes are broke in just a few years after leaving the NFL or leaving the NBA because they don't know what to do with their money. So you need to know how to now multiply your income, but the only time this becomes super useful is when you know how to do everything else. That's why I put M here instead of earlier on. First, you need to know what to do with your money. Once you know what to do with your money, then you can know how to grow your money. So how do you grow your money? Well, you gotta know yourself. And that's gonna sound like a really dumb answer because, well, how do I know myself, I'm a really good looking guy. How is that gonna make me any more money? Well, knowing yourself means knowing what you're capable of and know what you're willing to do. I used to say that everybody should go out and try to start a business. Everybody should go out and try to start their own side hustle. But then I worked with some people trying to do that, and some people killed it. They did a great job. They were able to make a lot of money. They were able to build a whole new income stream for themselves, and other people that I worked with very closely could not do it. They did not have that discipline or that drive to do it themselves. They needed that direction. And so not everybody can start a business. Not everyone's going to be able to do that side hustle themselves. So if we start with knowing yourself, that means, okay, if you are not able to start a side hustle, you're not able to start a business, you know that about yourself, that means you got to figure out how can you maximize your job? Mm-hmm. How can you provide more value to your company? That might mean looking for a raise. That might mean trying to take on more hours. That might mean trying to do something that way you can earn that more money from your job, or maybe taking on a second job, depending on what your job is. Or if your job, your industry is not cutting it, go and get another certification. Go and learn something else. Go and try to do something else. Get an internship. That way you can try to earn more money from your employment. If you say, well, I don't know myself, then try something else. Go out and try a side hustle. There are so many different things you can do, especially with the internet. Go out and become a freelancer. Go out and work for DoorDash or Uber or Lyft. Go out and try to mow people's lawns. Go out and start a social media agency, a marketing agency. Go out and try to start a podcast. I mean, there's so many different things that you can do, and then try it. Either you're gonna love it, you're gonna love the risk, the grit, the learning, or you're gonna hate it. Say, I hate it because I don't have a schedule. I can't keep up with it. I don't know what to do. If you can't figure it out, then you're gonna start to realize that, hey, maybe this isn't for me. And that's okay. There's nothing wrong with that. There's no shame in that. It's just everyone is different, and you got to figure out where it is that you want to be. And if you do like that side, then maybe, okay, you take a side hustle on in addition to your job if you can manage both. Or you try to start your own business. Now again, you start to see where that risk starts to come in, because starting a business is risky and it's hard. It takes a lot of work. But this is where now you have to figure out what can you do to fuel your system, right? You have this financial system, you have this machine where you know what to do with your money. All you need to do now is figure out how to add fuel onto the fire, because now you got the fire. You know you're trying to buy assets. You know what you need to do with your savings. You know how to spend your money. You've already built the foundation. Now is how do you amplify it? How can you put more money here every single week? How do you put more money into your assets every single month? Because every time you buy more assets, you have more things that are paying you. So this is where you got to do M to know yourself. That way you can start earning more money. Once you start earning more money, now you're really getting towards wealth, right? You're making more money. You're managing your money the right way. You're doing all the right things, which brings you to the top of the climb to wealth mountain. B.
We finally made it.
We made it to the top. Be great. And so this is actually very, very, very important. And a lot of people forget about this. When I talk about being great, this means being great for your family and being great for your community. When I talk about being great for your family, that means protecting your assets. So I'm a licensed attorney. I don't work as an attorney. But one of the things that I learned is if you do not know how to protect your money and you have money, people are going to try to take their hands, put it in your wallet, and take some of your money out and put it back into their wallet. I have been sued. My real estate company was sued, a frivolous lawsuit, because a tenant said that the bathtub was too slippery when the water was on.
Oh, man.
True story. And they tried to sue my real estate company for $150,000. During the lawsuit, which was a big headache, we learned that one, not only did they claimed that they slipped and fell because the bathtub was too slippery. Not only did we learn that they did not slip and fall in the bathtub, they slipped and fell at their friend's barbecue, but we also learned that they made a complaint that the bathtub was too slippery. We sent out our contractor to go inspect it, to go fix it, and provide them with some extra help. We were gonna put in a handicap pole, because if it was slippery, when our bathtub's not slippery when the water's on, but we were gonna give them a handicap pole on top of that, but they denied all of this. But they were trying to go around and try to, put their hands and try to say, hey, this must be a rich person, let me get some of this money for myself. So you have to know, how do you create these type of financial shields for yourself? So the first thing is you need to have insurance. This means insurance, health insurance, car insurance, home insurance. If you have real estate investments, that insurance. You have a business insurance, life insurance. These things are, not fun. Nobody enjoys paying for insurance, but it's a small cost you pay today to protect you against a major headache in the future. So this is one of those things where you can't really get around it. You need to protect yourself with that. Second thing is, now as you start to become wealthy, you need to start thinking about what's next after you, right? Now we're talking about wealth, which means generational wealth, right? So that means estate planning. Talk to an estate planning attorney about building a will or a trust, because if you die and you have money and you don't tell the world how you want your money to be distributed through a will or a trust, well then the government's gonna come in and they're gonna decide how to distribute your money. Now, little tip, you never want the government to decide what to do with your money. So be proactive with it. Create a will, create a trust, talk to an estate planning attorney, so that way you can learn what you should be doing with your money, with your assets, because if you don't do that, not only is the government going to be deciding, but then your family is going to get into fights. They're going to be disputing over who gets what. Decide that earlier on. And I also talk about being great for your community, because the more you have, the more you can do. I talk about how you can light the world with one candle, because if you have one candle, you can light another. If you have another, that can light two more, and then you can light another one, you can light another one. So it's slow progress, and sometimes people just need a little hand. And there's a lot of different ways you can do that. You can, whether it's donating money, donating time, donating your education, because now that you're learning how to do things with your money, go out and teach someone else. Go out and help somebody else. You never know where somebody is, and sometimes people just need a little bit of a push. And when you become more wealthy, you have more resources to do more. You have more ability to do more good. And remember, we're one world. Help people out. We're all people. So, once you get to that B, remember to be great. So you talk about building wealth, a system. There you go. The climb to wealth. Now this is kind of a unique video, but take it from the C to the L to the I to the M to the B. Kind of rapping there.
Yeah, I was going to say,
the
wow.
climb to the wealth. The climb to wealth. But if you enjoyed this video, let me know in the comments. If you want to see more videos like this, let us know in the comments. That was Nate. If you want to see more of Nate, check out the Minority Mindset News channel. He's posting videos every day, sometimes multiple times a day, on what's going on in the top finance and business news. His videos are amazing. So if you have not subscribed to Minority Mindset News, make sure you do that. I am Jaspreet Singh, and as always, keep hustling.
So my thinking is I have no problem spending money as long as I could get that money back. So it's like no different than a savings account. Same thing with the car, the Ford GT. It's a very expensive car, but I see that as an investment that's worth more than what I paid for it. And I'll be able to sell it, worst case, and just break even.